A lot of these jobs are low-paying part-time jobs, and none of that has changed. So we're not creating the kind of jobs that we really need to create if we're going to make America great again. But I think what a lot of people are missing about the report, they focus on the headline beat. Yes, we created more jobs, but if you look beneath the surface again at some of the trends that could present a problem, at least for the Fed, we had a surge of people joining the labor force, re-entering. Remember, labor force participation has been declining. We have a record number of Americans who are not working. And now we saw a big influx of workers. And why is that happening? Are people now more optimistic? Do they actually think there might be some jobs out there and they want to look for them? Or are they finally, running out of money? Maybe they no longer have the luxury of not working. They've run out of credit, and now, circumstances are forcing them back into the job market. But if this is a change of trend, which is long overdue, right? If people are going to start coming into the labor force, then 220,000, 250,000 isn't going to cut it. I mean, that was okay when everybody was leaving the labor force, but we had something like 700,000 people enter the labor force, yet most of them weren't able to find jobs. That's why the unemployment rate ticked up. Both the U6 unemployment rate also came up, where the part-timers and people who are discouraged. So we're seeing a move up in unemployment, and labor force participation ticked up. The unemployment rate ticked up. And if we're going to get more and more workers coming into the workforce, unemployment is going a lot higher. Even if we keep creating 200,000 jobs a month, that's not going to cut it. And so the unemployment rate is going to go up. And if you look at what happened to wages, wages were supposed to rise by 0.3%. Instead, they only rose by 0.1%. And they took last month's, December's, 4.4% rise, and they cut that in half to 0.2%. So in other words, between the 2 months, wages rose by 0.4 percentage points less than what they thought. And what the dynamic is, as you get this huge influx of workers into the labor market, they're competing for jobs. They're driving wages down. Employers now have more choices among who they want to hire. And this is happening despite the big increase in the minimum wage. Remember, a lot of states raised their minimum wages in January. And despite that, you have this anemic wage growth. And so I think for the Fed's going to see rising unemployment, stagnating or falling real wages, and that means the Fed is going to start to soften its rhetoric on rate hikes. Again, I said I don't believe we're going to get 3 rate hikes this year, but I think with rising unemployment and wages not going up, you've got all these Keynesian Phillips curvers on the Fed. They think inflation comes from rising wages. They're wrong. In fact, it's inflation that can cause wages to rise, not really the other way around. But I think if the Fed thinks inflation is not a threat because they have rising unemployment and no wage growth, they're going to be backpedaling. That's why you're seeing the dollar continuing to weaken despite the better than expected number. In fact, if you look at January, this was the weakest January for the U.S. dollar in 30 years. Gold prices are rising, commodity prices are rising, and for all the hype about Dow 2000, the U.S. stock market is pretty much the worst performing stock market in the world so far in 2017. If you adjust for currencies, the real gains are happening overseas, in foreign markets, in emerging markets, in commodities. It is very reminiscent of what happened when George Bush replaced Bill Clinton. They still think this is all medicine. They don't realize how toxic it is. So, yes, of course I expect them to continue that. And the fact that the Dow is at 20,000, that doesn't reflect a healthy economy. It reflects a bubble. I mean, the U.S. economy wasn't healthy when the Dow went up in the late 1990s during the tech bubble. It didn't reflect economic health in 2007 when the financial crisis was right around the corner. It just reflects financial engineering, bubble blowing. U.S. stocks are very expensive. Candidate Trump had it right when he called it a big, fat, ugly bubble, and it's bigger, fatter, and uglier now. And the fact that he's president doesn't change it from a bubble to a bull market. It's still a bubble. The air is going to come out one way or another. Either the U.S. stock market is going to crash or the dollar is going to crash. But either way, the real value of U.S. stocks is coming way down, and people shouldn't own them. They should be investing abroad. They should be investing in gold and commodities. That's exactly what happened when Bush came in after Clinton. Clinton presided over a stock market bubble and over a dollar bubble. People expected that to continue. Under Bush, instead, the bubble popped. We had false prosperity under Clinton. We had false prosperity under Obama, even though it wasn't even that prosperous. It was still phony. But you blow up these big bubbles, and then they pop. And sometimes they pop on the Republicans. But it's not their fault. They're just inheriting the bubble. Although certainly Bush, when he inherited a bubble from Clinton, when that one burst, he presided over an even bigger one. But the culprit, again, was the Fed. It was the Greenspan Fed that caused the bubble under Clinton. Greenspan caused the bubble under Bush. And then when that bubble popped, then you had Bernanke and Yellen, who have inflated a far bigger bubble that was now passed on to Trump. And this bubble's bursting. And, it's interesting, Trump just last week, he signed some, they're going to try to deregulate a bit. They're going to try to roll back Dodd-Frank. And I can just see it now because we're going to have another financial crisis. And just you wait, the left is going to blame it on deregulation. Whatever deregulation Trump is able to pass is too little too late. There's a lot more that we should do. But it's not the deregulation that's the problem. It was the regulation that created it and the Fed. Well, the United States is bankrupt as far as I'm concerned. We're insolvent in whether we have the ability to actually repay the money we've borrowed, other than just run it off a printing press. Sure, we can print all the money we want, but then we destroy the dollar. But we don't have any way of repaying the debt legitimately with real purchasing power because we simply can't raise taxes high enough to repay what we've borrowed, especially if interest rates return to normal. So I think it would be a good thing if Trump presided over a bankruptcy officially where we, defaulted on our debt and we asked our creditors to accept a haircut. That's what Donald Trump originally said when he was a candidate. And then when it kind of blew up, he backpedaled and said, well, we would never have to do that. We would print money. Well, that's the coward's way out. That's the politically expedient way out. That is bankruptcy. It's just bankruptcy by a different form. And unfortunately, I think the consequences of that type of bankruptcy, a massive devaluation that potentially could run into a hyperinflation, that is much worse for everybody, including our creditors. I think our creditors are better off with a legitimate haircut than having a complete crew cut with massive inflation. Bankruptcy is cleansing. Bankruptcy is an important part of capitalism, right? If you make mistakes, the market wants you to go bankrupt, so you stop making those mistakes so that you free up resources to be reallocated and reinvested more efficiently to actually satisfy the desires of consumers. If you've made a mistake and you're not able to do that efficiently, the market wants to bring an end to that activity. And so that has to happen on a national level too. We really need to reorganize and restructure the economy. But I don't think the Fed has the stomach for that. So it's not that the Fed has to do QE. They only have to do it from the perspective of they want to prevent the bubble from popping. They want to blow more air into it. They want to try to delay the day of reckoning, which is how they have done it this far. So I expect the Fed to reverse course. I expect them to come back with another round of quantitative easing because that's all they have. It's just like a medieval doctor. They leech you and then you don't get better and then they leech you some more. They don't decide maybe the leeching isn't helping or maybe it's actually making it worse. It's like that's all they know. They're convinced that it works and so they keep doing it. So the Fed believes that everything they did in the past was correct, even though it was a complete failure. But because they don't recognize their mistakes, all they do is repeat them. So they're going to do that. And even if we do get some more quarter-point rate hikes from the Fed, maybe we will before they reverse course. I still think they probably won't. But to the extent that they do, it's only going to be because inflation, even the way they measure it, is rising at a more rapid rate. So that even if the Fed hikes rates will still be lower than they were the last time they hiked because inflation will have accelerated more than a quarter point. So in other words, you could get a slight increase in nominal rates, but as real rates are actually declining. But at some point along the way, the Fed is going to reverse course. We are going to be back in recession officially, probably this year. What's the odds that we're going to make it through this first year without going through an official recession? I think it's pretty slim, especially if we do something to inhibit trade, if we have some kind of border tax or some kind of tariff, that's simply going to accelerate the move into recession. Yeah, well, there's going to be pressure all around the world. Look at the official inflation rates now in the Eurozone. Look at Germany. I think you're going to see a lot of pressure from the ECB to get, from the Bundesbank on the ECB to start to wind down their stimulus program over there. I think that's going to be the ironic twist that surprises so many traders. You know, what the view has been for so many years was that the divergence in monetary policy would be the Fed tightening while the ECB continued to ease. I think the reverse is going to happen. I think it's going to be the ECB that begins to tighten just as the Fed actually begins to ease, right? They're going to start preparing the markets for rate cuts and more QE, just as the Bundesbank the ECB is going to have to be removing the punch bowl. So that is going to be big for the currency markets. As far as the bond market, I mean, this bond bubble has been going on for a long time, right? And, you know, you've got a lot of people who have tried to short this bubble, and, you know, the cemeteries are littered with the carcasses of people who call the top of that bubble, and then it keeps on going up. But, you know, maybe we have seen the highs, but the Fed is going to come in. The Fed is going to try to keep interest rates as low as possible because we have so much debt. It's these artificially low rates that are the only reason that we can service it.